What's up guys, my name is Nick and welcome to my channel. In this video I'm going to give you all my criteria I look for when building a watch list of stock and ETF tickers that I want to trade options on. While many of these criteria are still relevant for larger portfolios, I want to break it down specifically for smaller accounts in the $2,000 to $5,000 range. We've seen an explosion over the last year or so in the number of new traders in the market, and I thought this would be useful for those of you who are looking to transition from long only, speculative, out of the money option buyers on the current in vogue stock to longer term investors looking to build consistent income from an options portfolio over time. This video then will help you build a list of appropriate stock and option tickers to help you achieve this objective. What I haven't done today deliberately is break down how to physically build a dynamic watch list on your broker platform, whether that be Tastyworks, Thinkorswim, or Interactive Brokers. This differs from broker to broker, of course, and is typically relatively simple to do anyway. If, however, your broker does not have a dynamic watch list tool, that's a watch list where you put in the specific criteria you require of a stock or an option, and then the software populates a list of ticker symbols that qualify, then you should probably look to open another trading account. In this day and age, this kind of basic functionality should be standard in every platform. In my research for this video, I wasn't able to find any free third-party website or software out there that could adequately do this job. So if you're unable to build your own list right now, I've put together a spreadsheet of almost 50 tickers that meet all the criteria right now, and I'll give you details of how you can access that watch list towards the end of the video. Before we dive in though, do me a huge favor, smash the like button, subscribe to the channel, it helps me out a ton. With that said, let's get into it. As with any watch list, regardless of account size, my first and most important screen is one of liquidity. This not only includes a requirement for high volume and open interest, tight bid-ask spreads, but also the listing of weekly options and appropriate strike price availability. While I'm not going to go into very specific numbers for volume or open interest, it should be fairly obvious even when you take a look at an options chain as to whether it qualifies as liquid. You should see there is good trading activity, particularly in the front month, and in the at-the-money strike options. And prices will be tight, literally cents wide. This is forward stock, for example, and it clearly constitutes a liquid, actively traded counter. Additionally, when building out my list, I also like to see a broad mix of industries and sectors. This is just one more way in which a portfolio can add diversification. My small account watch list, for example, includes not only stocks in a wide variety of industry and sectors, but also commodity exposures in oil, natural gas, and precious metals. I've also included currency exposure through a US dollar index trust. What makes this list specifically appropriate for smaller accounts though is that all the stocks and ETFs share one common trait. They're all priced below $30 a share. Why is that important? Well, while it's true that it's possible to buy cheap out of the money options on higher priced stocks and ETFs and risk a relatively small proportion of your account on a low probability long shot, this is much more difficult to do effectively if you want to consider short premium income generating strategies such as credit spreads, iron condors or butterflies. For these trades to be effective, it's important that spreads and wings are of an appropriate width relative to a stock's price and volatility. While it's possible to trade a $5 bull put credit spread on, say, Tesla stock for example, what we find is that a spread that tight, the two options have very similar but offsetting Greeks. So the 495-490 put credit spread has almost negligible delta and theta, and so newer traders become frustrated when they don't achieve the performance from the trade that they expect. Moves higher in the stock, for example, lead to very small gains due to the very low delta of the spread. Also, the spread decays extremely slowly due to the very small net theta. A wider spread, on the other hand, let's say the 495-435 put spread, now has far more appropriate Greeks. The position has a substantially larger delta and theta, and so the net spread behaves much more like a naked short option, but without the associated downside risk. Note, however, that the difference in the buying power of each strategy is over $3,000, and is clearly not realistic for an account of just $5,000. By focusing on highly liquid, low-priced stocks then, we can still achieve the benefits of wider, more appropriate spread widths with a more manageable risk and reduction in our buying power. I've tried to keep this video short, sweet and directly to the point. If you're interested in downloading my 2021 watch list for small accounts, I've included a link in the video description below. And hey, nobody's perfect. Did I miss any out? Drop me a comment below and let me know which stocks you think should have made the cut. Again, if you enjoyed the video, you can subscribe to the channel down here and watch more option-related content on the channel by clicking somewhere over there. Until the next one, guys, thank you for your support. Cheers.